Investors moved out of stock funds and into bond funds in 2011, according to the latest data from Lipper, a unit of Thomson Reuters. Taxable bond funds saw inflows of about $180 billion, while equity funds saw redemptions of more than $33 billion. Money market funds and muni bond funds also suffered withdrawals. Tom Roseen joins us with some insights and to help us determine where money may head this year. He's head of research services at Lipper. Nice to see you again, Tom.
Hi, Rhonda. Thanks for having me back.
It wasn't all bad for equity funds. ETFs did pretty well, right?
Yeah, in fact, people were very selective of putting risk on and risk off. We've heard that adage thrown around quite a bit. Investors were really looking for an opportunity to get in and get out quickly. So we see a lot of the money going out of, let's say, traditional long equity funds and going into non-traditional or the ETF equivalent. So we've seen a lot of money flows into the ETFs with the particular equity exposure that they just came out of.
Well, it's also interesting, too, I guess, with what's happening with bond funds. We still have, in 2002, continued turmoil in Europe. Are investors becoming more conservative or handling their bond fund choices any differently?
Well, actually, I think the people are becoming a little bit more conservative. We have the graying of America actually occurring. Something like 77 million of the Americans here today are entering retirement or baby boomer age group and are thinking about retiring. This has been a major issue. So we're seeing a significant change in the paradigm of their investment strategies. Money is going out of equity funds. I don't think they're voting against equity funds, mind you. I think they're reallocating towards the fixed income funds so they can actually secure that retirement they've been saving for.
So what are you expecting this year now? Obviously, it's early days, but will that reallocation continue? Will stocks remain out of favor?
You know, I think they will. I think there's going to be some select areas people will go into. For instance, we've seen people putting money into utility funds. We've seen people putting money into the real estate funds, or really kind of the income earners that people wanted to get into. I think we're going to see that strategy continue. Again, the grain of America, baby boomers are going to want to have income distributions at their hands. But we do believe that this move towards fixed income is going to stay around for some time. So we don't expect any real big changes. We see select equity funds taking in a good amount of money, but on the flip side, we do see a continuation in the growth of fixed income assets.
Tom, what do you think is going to be the most interesting trend in the fund industry in 2012 that investors should be aware of?
Well, again, I think this is going to be the major issue is what are people going to use for their retirement income sources? So we see a lot of different, asset allocation groups coming out with, asset location strategies. So people know to put their high income paying funds in a qualified plan so they don't get taxed a great deal of their money away from them. In addition, we see people putting a lot of money into the set them and forget them type of funds. So we're going to see money flowing into the target date funds and target retirement funds. And then last, we do continue to see people really reaching for yield, looking for our old mom and pop's utility funds. That has not been a popular place to be. In addition to that, we see people also turning back their attention to real estate funds. There's a nice asset class as far as yield goes. So again, traditionally, we've seen some money going into these assets, but I think we're going to see a larger contribution into those type of income-paying streams, and that's going to be the new trend we see, I think, for the years to come.
Tom Roseen of Lipper, good to talk to you, Tom. Thanks very much.
Thanks, Rhonda.
I'm Rhonda Schaffler. This is Reuters.